This video will help explain how a buyer can reduce their out-of-pocket cash requirement when buying a home by using one of three common strategies: seller-paid closing costs, lender-paid closing costs, or a combination of both seller-paid and lender-paid closing costs. These strategies can also help a client by reducing the amount of out-of-pocket needed to buy a home, help a buyer purchase a home today instead of putting it off until they save more money down the road, or three, it can free up cash for possible home renovations. Let's start by taking a look at what the purchase of a single-family home for $300,000 may look like with an FHA loan and 3.5% down. With a purchase price of $300,000, the down payment of 3.5% is about $10,500. The estimated closing costs are about $12,000. So the out-of-pocket cash needed from a buyer is $22,500. The total monthly payment in this example is $2,100. This includes the principal and interest, monthly private mortgage insurance, and the property taxes and insurance. It does exclude any homeowners association dues that may be required if the home being purchased is in a community. With this scenario, the buyer is required to have $22,500. This is understandably a large sum of money and may be more than what a first-time home buyer has available to purchase their first home. So let's take a look at some of the strategies that can help reduce the initial upfront expense. Seller-paid closing costs. This strategy is exactly as it sounds. The seller will pay a specific amount of the buyer's closing costs. Here's an example of how it works building off of our last example. Let's just assume that rather than finalizing a sales contract to purchase a home for $300,000, we offer the seller $312,000 for the same home and request that they pay $12,000 towards the buyer's closing costs. Here's how it looks. You have a sales price of $312,000. So it's $12,000 higher than our previous example. The seller will give a credit at closing to the buyer of $12,000. So the seller will net $300 after that credit. So for the seller, it's really no different than our previous example. They'll net $300,000 in both scenarios. Now, let's look how this affects the buyer's financing with the same FHA loan with 3.5% down. With a higher purchase price of $312,000, the down payment of 3.5% has increased to $10,920. The estimated closing costs remain the same at $12,000. However, you now have a $12,000 credit from the seller at closing for the closing costs. So in the end, when you add these three together, the buyer's cash outlay is $10,920 versus the $22,500 in the previous example. In this example, the monthly payment is increased to $2,155. So, the benefits of this scenario are the buyer is able to purchase a $300,000 home with just $10,920 versus $22,500. The monthly payment with this scenario is approximately $55 higher than the previous example. This is a pretty small increase considering the benefit of closing with just under $11,000. Other factors to consider when using this option: certain loan programs and financing types may affect how much the seller can actually contribute towards the buyer's closing costs. For FHA mortgages, the maximum allowed seller credit is 6% of the purchase price. Additionally, and very importantly, the credit from the seller can never be more than the actual closing costs. Additionally, the property must be appraised at the higher sales price, in this example, of $312,000 versus $300,000. And lastly, not every seller will agree to this arrangement on a sales contract. Lender credit for closing costs. In certain scenarios, we as a lender can help the buyer reduce their out-of-pocket expenses with a lender credit. Here's how it works. Let's assume the interest rate for an FHA mortgage is 4% on any given day. A lender has the option to offer a higher interest rate to the buyer, say 5% instead of 4%. This allows the lender to provide a credit to the buyer for their closing costs. So you can consider it a trade-off. In exchange for taking a higher interest rate over the life of the loan, the buyer will receive a credit from the lender of 3% of the loan amount at closing for their closing costs. Here's how our original example of a $300,000 purchase would look like with a lender credit. The purchase price remains the same at $300,000. the down payment of 3.5% remains the same as the first example at $10,500. The estimated closing costs are the same. However, we now have a lender credit for closing costs of $8,837. This is roughly 3% of the loan amount. So the out-of-pocket cash requirement for the buyer in this example is $13,663, and the total monthly payment would increase to $2,274 per month. With this example, we're able to reduce the out-of-pocket cash requirement for the buyer from $22,500 to $13,663. This option also doesn't require the seller's approval at all. So you may have this as more of an option than the seller credit option. And it doesn't require the property to be appraised at a higher amount. Other factors to consider: the buyer does pay a higher monthly payment over the life of the loan as a trade-off for receiving the larger lender credit at closing, and a lender credit may not be able to cover 100% of all the closing costs. Scenario 3, a combination of seller credit and lender credit. While the first two examples assume we proceed with either a seller credit or a lender credit, we often find in real-world scenarios that it's more common to see a combination of both. Here's an example that looks at using both a seller credit and lender credit to help a buyer lower their initial cash outlay for our original example. The purchase price would now be $305,000. The down payment of 3.5% would be $10,675. The estimated closing cost would remain the same at $12,000. But now we're looking at a seller credit for closing costs of $5,000. And notice that the price increased from $300,000 to $305,000. This is because of that $5,000 seller credit. In this example, we also have a lender credit of $5,990. Not quite as large as our last example, but still about 2% of the loan amount. Additionally, in this case, the interest rate increase is not as high as in the previous example because we're only given a 2% lender credit versus the 3% lender credit. The out-of-pocket cash requirement for the buyer in this example is $11,685, and the total monthly payment is $2,232 per month. So the benefits in this example are: the buyer is able to reduce their out-of-pocket cash requirement to $11,510 from the original $22,500. It doesn't require as large a seller credit and is more likely to be approved by a seller. Other factors to consider: the higher sales price of $305,000 does require the property to appraise at the higher amount. We hope this informational video has helped explain some commonly used strategies to help homeowners reduce their initial cash outlay when purchasing a home. We've used very general assumptions of costs, interest rates, property taxes, and homeowners insurance premiums for examples. Please keep in mind that different markets may require some of these estimates to be more or less than our examples. Also, all scenarios are subject to a buyer's qualifications. Thank you for watching, and don't hesitate to contact us if you'd like to have additional information on how to make these strategies work for you. Thank you, and have a wonderful day.